Okay, welcome back, everybody. Glad to see you again. Nice full room still. Very happy to see that. Today, first we're going to go over a couple of things we talked about last time. So last class we talked about our diagnostics, a few things that we like to look at when we're evaluating the current situation. Look at going forward. One of those being income and expenses. Now I could sit here and we could go over a budget for several hours, but I'm sure you're familiar enough with finances to be able to roughly, give an example of what you're going to be looking at today and in the future. So again, here's some of those common examples of income expenses that you might have. Let's take account for when you're looking at your income planning, mortgage, healthcare, all of the stages are required. Major activities. And then obviously we talk about future expense planning, taking those current expenses and projecting them forward, whether you're expecting them to be greater or less. That information is super important for your investment decisions because the lower your expenses are, the less capital you need to start out in that first year. The higher they are, the more you need. Less capital you have today, more aggressive you need to be to get there. Less capital you have today, more capital you have to be able to more conservative. So all of this information is super helpful for the stuff that we're going to start talking about in the next couple of classes. All of this stuff, all the things that we're talking about, the income planning, how much you need for your capital, that all gives you the basis for which you decide how to invest in the future. Again, we talked about some more insurance ideas, some of the things that we want to have covered, how we use the insurance that shouldn't for our assets, in order to keep things from getting eaten away, or we have to just use them in the first place. Things like medical, long-term disability, long-term care, life insurance, homeowners, auto, liability, making sure that in all of the areas that's feasible and reasonably accessible in terms of cost for us, that we have our coverages maxed out as much as possible, and then protect our assets again from those catastrophic events that could talk about estate planning, just whatever the super basics of wills, trusts, and how we might use them, and how wills are really good for simple estates or small estates where there's not a lot of assets to move around, and trust can be much more sort of very large estates or very specific instructions, have certain qualifications we want beneficiaries to have, but when they receive assets, trusts are super useful. Beneficiary designations, think of that as a super simple form of what comes before. Things like beneficiaries on insurance policies or transfer on debt accounts that allow those assets to be mentioned before. Perhaps right beyond that probate experience, you get right to the assets. We talked about power of attorney, durable power of attorney that stays strong through your incapacitation. Think like a negative power of attorney that lets somebody make decisions for you on your behalf, or financial or legal power of attorney that allows you to do things like pay the bills, credit cards, and debts, and make other financial decisions for you or otherwise not able to do so. Something I'll mention about the power of attorney that is useful is a provision called spring forward. That creates an event where the power of attorney is essentially dormant for a little while until a certain action or circumstance occurs, in which case it activates that power. So having a spring forward durable power of attorney would be something like have a dormant financial power of attorney with somebody that you trust to pay for your bills after you're incapacitated. When you become incapacitated, you get hit by a car, it's really bad, you go into a coma, that power of attorney springs forward and now can be utilized by that person to make decisions for you. Meanwhile, while you're able, it would not give them the power to step over. That's something you can consider. Talk a little bit about our tax diagnostic and how it's kind of difficult to pay less in taxes, but there are things that we can do to make our money more efficient in our tax life, things like tax advantage investments, tax credit investments, and remembering that tax-free returns often are pretty equivalent to taxable returns. The difference between mutual funds and ETFs on a very basic level. How mutual funds will disperse capital gains to you as the investor. ETFs generally not. We'll talk a little bit more about that today. tax deferred annuities, tax deferred investment vehicles or nuclear IRAs, 401ks, and Roth accounts. So today we're going to just get into the super basics of our investment ideas. We'll talk about different account types that we have, funds and market indices, portfolio diagnostics, ETFs, all different kinds of things. So first of all, I wanted to start with the super broad strokes of account types. We'll have two basic types of accounts when it comes to investments and also. You'll have your first, which is a qualified account. So these accounts receive tax advantages. Generally, when we think of qualified accounts, the easy ones to remember are 401ks and IRAs. Accounts that when you contribute to them, you get to defer the taxes on those dollars put in until the later date. Something like a 401k where you have your elected deferral of your salary, and you choose to have a certain percentage or a flat dollar amount go into this investment account and not pay income taxes on until a later date when you decide to put it out. These qualified accounts generally will come with some penalties for taking money out early because that's the price you pay for getting the income tax deferral. So on things like 401ks and IRAs, you'll have a pre-59.5 10% penalty. And it's shocking how many people sort of don't really think about that or just forego the idea of that that's a bad thing. And taking money out of that account early, they won't pay the income taxes that you deferred earlier on, as well as the 10% penalty back on top of that. So that can get really aggressive to the dollars that are coming out of that. You can also think of a qualified account, something like a Roth account, where you might not necessarily be getting current tax deduction, but you are foregoing income tax on those earnings, so you are still getting a tax advantage. Non-qualified accounts are basically accounts where you still pay taxes on all the money coming in, and you pay taxes on all the money that is generated in the account on the day that it's generated, or in the year that it's generated. So there's nothing really deferred until it comes out. It's just paying taxes on it as they are. So that will be something like your individual accounts, trust accounts. So a couple different examples of qualified accounts, like I spoke about, you'll have your company retirement plans, like 401ks, 403bs, 457s, your profit sharing plans, ESOPs, and all your different IRAs. And even 529 plans can also be considered qualified as tax in and for qualified expenses. For your non-qualified accounts, like I mentioned, individual accounts, what most people are going to be familiar with, that'll also include joint accounts like joint tenancy with rights of survivorship and tenancy entirety, as well as community property ownership, like an account you're comfortable with your spouse. This will also include things like trust and saving accounts, which are also not qualified and will pay very high tax rates as a trust. Custodial accounts for minors, like uniform gift minors accounts and uniform transfer to minor accounts, those are also taxable, but they're taxable to the child. So you'll have to be somewhat familiar about the minor's tax rate. There's some interesting tax deductions that go along there. Generally, they're not paying very much income tax, but in some circumstances. Business and entity accounts will also be included in this. Those are pretty much kind of the same as
minor account that includes 529.
No, so 529 of the qualified account as you're getting tax benefits for that. And that's because that's used for a specific purpose. You can kind of think of it in somewhat of a similar aspect as an HSA, whereas when you're putting money into the HSA, you're getting really good tax benefits because you're supposed to only use health expenses. Same thing with the 529, getting those tax benefits because it's supposed to just be for education benefits. So that's why that would be considered a qualified account. These are different things. A lot of times people just like trust accounts for stuff like this instead of money accounts.
So I remember it used to be, maybe still is, when we figure it right, for a minor's account, if their dividend income is more than the minimum, more than the is higher than the lowest level, don't pay taxes there. They have to pay taxes on that.
I believe that, yeah, they have like some different like standard deductions and much more generous tax relief They have paid as parents. So moving forward, we'll talk about some of the most popular investment vehicles. A lot of this is going to be super basic. You should be pretty familiar. Stocks, as we know, their ownership is a piece of a company. When a company goes public, they'll issue a large batch of stocks and they'll sell it in the market. And you can be one of those owners. You can buy it from the IPO or the company issuing the stock, or you can buy it from a friend who owns 100 shares of Apple. And these might be entitled to a share of some company earnings also as dividends. So sometimes you'll have a little slice of the pie when there's profit in a company or earnings on the shares, distribute something out. With bonds, we're basically just talking about ownership of debt. Generally, what happens is the purchaser of the debt is providing capital. So in the basic example of a bond, most of them sell $1,000 of par value. If I'm giving I'm selling or I'm purchasing the bond for $1,000, I'm getting interest for my time so that I can compensate for not having my $1,000. And then once we reach the end of the term, I will get my initial principal back, that $1,000 par. And that's what's known as maturity. It's that big win. Now, there is also something known as an original issue discount bond or a zero coupon bond. These are bonds that don't actually pay interest, but rather when you buy them at a discount to full par value. So an example would be if you were to buy something like a T-bill, if you wanted to buy $15,000 of T-bills, you're probably going to get more like $14,500 or $14,000, and then you're going to get back your $15,000. Now, because even though they don't pay interest, you still, depending on the bond, will pay tax on that interest in what's called imputed interest. You kind of have to have your own calculation of what interest means. It would be paid to make up for the difference between the discount and the par value and tax. So a couple different examples of this would be the T-bill and the strip bonds, which are basically taking a bond, strip off the interest payment and the principal. That principal then sells at a discount, and those interest payments sell separately. Commercial paper will also be an idea of this. These are super short-term debt instruments by companies. So again, original issue this. You might sometimes see that abbreviated as OID out there. Okay. Mutual funds and exchange traded funds that we use all the time in our practice, our favorite way of doing things. These are baskets of securities in the most basic forms. They can be just individual strategies. I've heard of some funds that, for example, trade Tesla stock in some specific way. But for the most part, when you're looking at mutual funds, yes, what you're looking at is a basket of securities, some sort of overall strategy, following index, or some of it. This could be actively managed. They could be making trades back and forth, or it could be unmanaged. It could just be you buy a set and you hold it for a long period of time, and when the thing with the currency changes, then we change. These could be stocks, bonds, derivatives, things like futures contracts and options contracts, or even alternatives like real estate, commodities, all sorts of other types of investments. Oftentimes, these will take strategies or investments that are not readily available to a normal customer, package them up in a nice little bundle, and then sell them to you for a little bit of a fee going on more than full investment. Fixed annuities are another example. Though we're not a great fan of annuities, it's still good to be familiar with them, especially if you have old ones and still have to deal with. They're a type of insurance contract where the issuer promises to pay a stated interest rate on all the contributions made to the account over a specific period of time. This period of time oftentimes will be lifetime, so it'll be calculated number of years based on the life expectancy that they'll pay out, and they'll calculate that payment, and then they'll just pay it until they die. And sometimes it'll be over a period certain, that could be 10 years, and oftentimes you'll see life plus period certain. So you might have your life, and if you die before the period certain is over, it will continue to pay until into that period. Another type of annuity that we are very much not a fan of are index annuities. They're similar to fixed annuities, but the interest credited to the account in the annuity is based on the performance of the investment index. That's a very important term to think about based on, because they're not actually investing your dollars in stock. They're taking your dollars and investing them for themselves, and then depending on how the index does, they'll credit you some of the performance that index sees. Generally, and this is where that starts to come into play, interest rates are generally limited by caps set by the insurance company. So you'll hear something like participation rate. Oftentimes you might have 80% participation rate. So the stock index goes up by 10%. Rate went up by 10%, but you only got 8 of that. But then there's also rate caps. They'll set hard caps on the interest that you're allowed to earn on your annuity account. And sometimes those will end up making the amount of interest that you get even less than the participation rate. But you can have participation rate of 80%, but you might have a rate cap of 7%. So if the index generates 10%, and that's what you're based on, okay, my 8% of that, but I'm capped at 7, so I really only got 7. So the interest company or the insurance company walked away with 3 risk-free. I just got that. Index annuities are part of the category of
Sorry, how would they sell that to you? I mean, why would you invest in something like that?
generally, the way that they do it is they promise you that there's no downside risk. Because it's interest credited to your account, you're not actually investing. Technically, you don't feel any of the downside. But the problem is when you look at this over the long term, statistics play in their favor every single time. They're not selling you a product at a loss. They're always, every single time, all of this protection, all of this stuff, they're selling you. They said no downside risk. Over the long term, they win hand over fist, and it's just not even close. So a lot of people get swooned into these products because they're scared of the stock market, but they still want to be in it. They'll hear from their financial advisor or friends they need to be investing in this, but they're scared of what happens if they lose money. Insurance company walks in and goes, well, lucky you, we can give you this product that gives you returns based on that index, but no downside risk. But you'll have the tax, participation rates, and all of the fees and commissions you pay along the way that eat your price.
Are you saying there's absolutely no connection to the index to what's into it? They just say, they just compare it, it's not connected to the index and everything.
For the most part, yeah, because it's just a comparison. Like they look at the index and go, okay, if return 10, you get to participate in 80, but really you're capped at 7 or whatever their rules are. It's really just, that's where they get the data to base their interest on, because it's not an actual investment.
And that's why the insurance salesman doesn't have to be licensed in securities, because it's not a security. They're just using the index as an example of what will pay you interest on. And you're not earning dividends off the interest, that index. If you have it in front, they're not paying. Exactly. Yeah. And it's like buying one bond. If that company went out of business, all your money's there. They're selling you this guarantee, but what if they fail? Now, there are some insurance backups within the state that you're in, but still.
And what they guys don't really want to, they put it from the stock market, how somebody.
They can do whatever they want.
Yeah, they have insurance guidelines though. Executive life back in the 80s when I started, I think when the state stepped in and saw that they were paying high rates of interest and they were investing in junk bonds, making the portfolio of the company at risk. So the state stepped in, closed it down, and other companies had to take over. If I were selling you the annuity, I'd say, don't worry about it. Other insurance companies will buy them out because they don't want the bad reputation. The state has an insurance group that will pay you 80% of the first 300. But at the same time, if things got real bad, we remember 2008. So if you like bonds, it'd be better to have an index that has several ones, not just one annuity, which like, yeah.
So we're just not a big fan of this. For the most part, like, yes, there is the promotional safety that comes with not having downside risk, all these sorts of things. But again, one thing that I always like to remind people of when they think about index annuities or variable annuities, whole life insurance, all these sorts of different products, is great. There's all these benefits that we're getting, but who do you think pays for that? You do. You pay for it. Your dollars are the ones that pay for it. Oftentimes people will get so so enamored by all these different things that their life insurance or their annuities are promising. But then at the end of the day, your dollars are the ones that are paying for the benefits. It's like adding providers in your insurance policy. But it's going to cost more, or it's going to find your cash value or whatever the deal is. Whether you see it or not, you're paying for it. So that's just something I always want to keep in mind. If you're willing to pay for that benefit, by all means, they'll make your insurance agent happy, give them their nice big commission, go for it. But you've got to understand that you're going to be paying for all of this stuff that they're advertising. And sometimes you can generate that yourself if you just go work.
But the insurance agent said, I don't pay the commission, the company does, right? But it comes out of yours through surrender charges.
You'll often be locked in, like you mentioned, surrender charges will often make it such a bad idea for you to take your money out of the policy that you're forced to remain there. So there's just a lot of things you got to understand before you get in. Once you get in, you're in, you're stuck. A lot of times it'll be so much worse if you get out of the policy than what the bank says, spend the extra time to figure out what it's doing. And then one of the last things that we have is non-publicly traded investments. They're not something that we like to really touch with. They're cold at all because they're not regulated very well. There's not a lot of insight into what's happening, and there's just not a lot of vetting you can do with non-public investments. Now, if you really know what you're doing, you're an expert. That's probably where the most opportunity is for. But if you don't know everything you're doing, you are not the expert. I do not put my trust in something that I don't have a long-term relationship. Limited partnerships are one of those things. A lot of limited partnerships have been sold over the decades, and have been disastrous for a lot of people's retirements and things like that. One that's popping up a bit recently, I get a lot of flyers in mail for this, is it's the Delaware State Trust. I forget exactly what it's called. But the whole idea is you have real estate, you don't want to pay taxes on it to sell it. Well, lucky for you, all we have to do is we take the real estate and we give you shares of this partnership or this trust. And you get to have ownership of the partner. And then we own the real estate and you own a diversified portfolio of real estate all across the country. Thing is, we don't tell you how much you get diluted immediately. Commission comes out of that. Management fees. They don't really tell you all this up front. And sometimes they might be a worse real estate manager than you are. That doesn't work out too well. Yes.
You can also stick a check.
Yeah, exactly. So those things just really want to know all the details, especially when they're not like really forced to disclose all of this publicly. You really want to make sure you understand. Yes.
But they have REITs and mutual funds that are REITs.
Yes, there are publicly traded REITs, which are totally fine if you're good with their strategy and they perform well. But non-publicly traded REITs are what we say right now.
Anybody experienced those in the past, limited partnerships? And in the old days, we go to a state dinner and say how smart this real estate developer is, and everybody gives them the money. And then they buy a bunch of properties, they get real estate commissions by them, they manage them, they get paid to manage them, and then they sell their management company to somebody else, possibly, if they want to. But we run into that before, because if they bought big loans on the properties and properties didn't sell, then they lost the properties to the banks, and then people were left with pennies on the dollar. So we like transparent investments, and you can look at everything immediately. But these other things are not regulated as tightly or as transparent.
So moving on, I can kind of know some of that. We want to look at mutual funds and ETFs and kind of understand what goes on inside of them. So mutual funds and ETFs can use a variety of assets to create a particular portfolio for their customers. A lot of the times what you might be familiar with is S&P 500 mutual funds, or growth stock funds, or dividend paying funds, or bond funds, and sector funds, all sorts of different things. But at the end of the day, it's a combination of a lot of these different assets, but they use their own picks or strategies or whatever it is that they use to create portfolios for the customer. Cash and cash equivalents, this is just stuff that can be converted to cash flow. And you're not experiencing a lot of up and down values. These will be things like savings accounts at banks, certificates of deposits, treasury bills, commercial paper and a lot of other money market instruments. Whenever you hear the word money market, that's kind of referring to a lot of these different things where it's just where you're parking your cash and you're getting pretty much the least amount of yield that you'll pretty much ever get in the debt paying instrument, but you're also paying and not paying for it. You're looking for that security. You're not looking for a lot of movement on that. This is when you're usually parking cash aside for some other purpose or as backup. Oftentimes funds will not be very heavily into cash and cash equivalents, but sometimes they'll be maybe 0.5% or 1% in cash and cash equivalents. And when you have a fund that's trying to track sort of the index, where 99% in the index, but 1% in cash, just in case it needs to redeem something out of the fund, might have a little bit of difference in terms of cash. Bonds, fixed income instruments that represent a loan, just like we talked about before. Usually these are corporate or government bonds. You'll have taxable bonds, mixed-free bonds, high quality, and junk bonds. Taxable bonds, it's just like what it sounds like. It's a bond where you are liable for the taxes on the tax-free. Usually will mean something like a municipal bond. When you get a municipal bond from your own state, that's when you can pay absolutely no taxes. But you might have a little bit of a questionable idea of how your state's budget is doing. So California, you might not be completely sold on their own finance community. So that's something to keep in mind. Junk bonds, we'll get a little bit more into the specifics of what this means later, but essentially junk bonds are anything below what's called investment grade debt, which will mean that it's getting a higher and higher chance of those debtors defaulting in their loans and not thinking about paying back. But because of that risk that you're taking, they will generally pay a much higher interest rate. High quality is investment grade and above. Usually you're thinking of really big corporations or governments, like that.
It's the bottom line, the triple B.
Triple B,
And then which way? So that's what we want to junk or.
it belongs to high quality. So triple B is kind of that sweet spot where people like to think we're taking on just enough risk to get that extra return, but it's not risky enough that I'm putting my money. Into that way. We'll get a little more into those specifics later. How to sort of evaluate bonds. Stocks, we talked about before. Security, also known as an equity, represents the ownership of a fraction of the issued corporation. Generally, when we think about stuff like United States equities, foreign developed and emerging markets, those are all examples of different equities. Have German stocks or Japanese stocks or Chinese stocks or anything of the sort, and all of that composes our equity portion to be part of the strategy of the fund. Alternatives can also be part of funds, like we spoke about before. Funds can do pretty much whatever they want as long as they disclose it. So alternatives are a financial asset that does not fall into any of the conventional investment categories. So we're not thinking about equities, we're not thinking about bonds, we're thinking about all the different stuff like real estate, like we mentioned, publicly traded REITs, that's in commodities like gold and silver. So we don't usually find that those are the best investments over time. Sometimes when the US dollar really tends to crash, they can end up spiking in value. But when I look at long-term charts, I see a lot of just a straight line horizontal. And sometimes it's coming up a little bit, but nothing that really hedges inflation as well as it seems like everybody says, at least in my experience. That's derivatives, like we mentioned before, a derivative is really just something that derives its value from something else. It's really just what the word is. So when we're thinking of something like a futures contract, you might be thinking about gold futures or silver futures. The idea is what's it going to be worth in the future at the time that this contract expires. So a lot of places. So for example, recently before the Bitcoin ETFs got approved, there were a couple ETFs that traded Bitcoin. But you might wonder, well, if nobody was allowed to hold Bitcoin, how are they doing that in the first place? Well, the way that they were doing that is they were trading futures based on the movement of Bitcoin, because those futures were still allowed to be traded in these ETFs, even if Bitcoin could not itself help. So that was something that they were doing for a while before the SEC finally decided to approve a whole bunch of these Bitcoin investments. Interesting to see that. Hedge funds are another thing that funds can invest in. So hedge funds are generally not available to the public. Because usually looking for people with several millions of dollars, if not billions of dollars. So the way that a normal customer might be able to get access to a hedge fund is get a fund that they're investing in, gathers up everybody's money and invests that for. So something to be very hedge funds is they're not exactly known for disclosing their strategy. They're not exactly the most transparent company that exists. They can't be known for giving, well, let's say, not exactly bigger strategy in the overall market. We saw that with things like GameStop and a lot of allegations of shorts, very complex. Like I mentioned, managed futures, that goes into that category of derivatives, where they can be managed futures contract. Generally, futures were used as sort of hedge a lot of times for commodities. Arts and antiques, something you're probably not going to see a whole lot of, but it is possible that all arts and antiques can be invested as an alternative. And for some reason, I've seen a lot of advertisements that those are going to be an inflation hedge. Really not sure where you're getting that from. Gather up all of the people and then pay all the fees. And I feel like you're not going to be hedging inflation very well. You're probably going to still be on the market indices are something that we like to use very often. At its basic core, an index is it's a way to represent a certain category or a certain sector or a certain market or any particular thing that we want to be able to evaluate. Used by investors and fund managers as tools to evaluate performance of the stock market. So there's a couple of really common ones that we'll talk about in just a second. But the market index fund tracks the performance of a specific grouping of stocks considered to represent the market or sector of U.S. stock market. So indices can range everywhere from the big stock indices that you hear every day, all the way down to super small little sectors like utility sector indices, precious metal indices, cryptocurrency indices. Everything under the sun could be grouped into a category. And generally, the reason we want to use them is kind of all agree that these indices tend to represent the sector that we name them after in some way that everybody can kind of come together and agree that it roughly estimates the general performance of that category. Because if you were to go and create your own list of every single tech stock on the New York Stock Exchange, that would take a while, or you could just Google for Morgan Stanley's tech index and follow that along. A couple of examples of these indices would first of all be the major three. These are going to be the things you hear on television and radio every day until Standard & Poor's 500, that's our S&P. It is a market capitalization weighted index of 500 leading publicly traded companies in the U.S. Generally, that just means the biggest ones. And we like to use this as a general estimation of the overall stock market because you'll notice that when you hear a lot of general stock market indices performance to the Standard & Poor's 500, you'll notice that the performance is generally very similar. So we like to say that a lot of the movement in the stock market is due to these top 500 companies. And so we might as well shrink our list to the top 500 so we can gauge the performance of the stock market generally on something like this. The Dow Jones Industrial Average would be something you're very familiar with, and it goes back a very, very long time. It has a stock market index that tracks 30 large publicly owned blue chip companies trading on the New York Stock Exchange and the NASDAQ. This has been a very, very long-term index, and we have a lot of data on it. But it's not something that a lot of new investors are looking at. So a lot of people in my generation are mostly looking at both the S&P and the NASDAQ. I don't care a whole lot about it. Speaking of the NASDAQ, it's a collection of the 100 largest, most actively traded companies listed on the NASDAQ stock exchange. Something about the NASDAQ is it tends to really favor tech companies. It really ends up a lot of things that happen with Google and Microsoft, stuff like that, will be those top 5 to 10 companies. Yes.
there are a lot of the same companies in the NASDAQ that stand for.
Very true, very true. Especially with those top 100 of each, it's gonna end up being a very, very intersected list of stocks. So you'll
How
notice
do
that.
you make use of the information to get both of them?
I mean, honestly, they're just gonna move very similarly. The NASDAQ will be a lot more volatile. There's fewer stocks in there. They're really on the same list. Standard & Poor's just has a lot more stocks in it, so it'll be a little less volatile. That's pretty much, it's not really too much of a point in trying to compare the two more, because again, those tech companies have just swallowed up so much market share over time that like these top, but it's like top 7 or 10 companies drive most of the movement stock.
So did you say, because I'm like super not informed about this stuff. The 100 top 100 NASDAQ companies are in Standard & Poor's, they are in there?
Yeah,
All of them are?
I'm not sure if every single one are, but I imagine.
Majority of
Yeah, pretty much
Wow.
most of them. And that's just mostly because both of them are creating a list based on size of company. And so we're doing that, and you have two different lists that are both creating the list based on company size. It's going to end up taking a lot of.
What's NASDAQ's limitation that they are not all up there, that they're just because they're all techy things?
Well, it's not necessarily that they're all tech, it's because they use slightly different calculations for what they're going to use in each. So you'll have market capitalization weighted, which I'm not sure what calculation NASDAQ uses, but they'll use slightly different ways to calculate that size. Because a lot of people will have different methods for saying what's a valuable company, what's a big company. It's just a lot of different ways to look at these things and gauge their size.
So I'm always wondering that the Dow Jones seems like they're dropping and adding more often companies. And just wondering, how do they, like they hit a record yesterday, right? Just wondering when they drop one and bring another in, they usually aren't the same market cap, their price isn't the same. How is the average? Do they weight it? And then this company, the new company, our stock is weighted based on, I don't know something.
Yeah, and again, that's one of the things that they have a lot of different ways that they will.
Yeah, it's primarily weighting who's the biggest company. So if somebody falls out for 4 or 3 months or 6 months, they'll replace them for that. We did that with Walgreens. Yes, something we don't. They earnings and the size and value of the company shrunk a little bit, so they had to replace them. And just for fun, if you have a fund, an index fund that's going to replace one stock, let's say get rid of Sears and buy Walgreens, what happens to the stock? Sears drops and Walgreens go up. It doesn't affect it very much. The other thing about the NASDAQ is that stands for National Association of Securities Dealers Automated Quotation System. And I think back when they started, the tech companies were on the board because the Dow, they weren't blue chip stocks. That's my folklore, I'm guessing. But it's waiting for them.
How often, are the S&P 500, the 500 stocks evaluated, and NASDAQ 100, how often are they evaluated? And they exchange out different stocks?
Yeah, that's a question.
They look at it quarterly. And they may make a change at the end of the year to see that happen occasionally. And that's why if you have a mutual fund, like Vanguard, S&P 500, let's say one of the big stocks blew up or something, right? And they had to get rid of it and buy another one. They'll use their cash, but they could trigger capital gain on. You didn't want to do that, they had to get rid of Sears, they had to sell it. Everybody pays capital gains on it. Whereas an ETF and Nash will talk about they can trade stocks and eliminate or reduce the capital.
Do they have that in S&P 500?
Yes.
Okay, so these indices are generated by a particular company. A whole bunch of other mutual fund companies will pay that company a fee in order to have the privilege to access the list. so that they can create investment products that follow them. It's kind of like when we just talked about the index annuity, how they base their returns on the index. These ETFs and mutual funds will purchase the list, and then they will create investment portfolios that index. So if I'm trying to do that myself, I might look at the S&P 500, look at all the different stocks, and then buy a couple shares.
Well, you can look at the difference. You look at emerging markets, like Tina's asking, response. You look at JP Morgan, Chase, any of them, they say emerging markets. It's how they slice the market. Some of them, it's just Asian only, European, travel Asian only. So when they say emerging market, they get the market.
Yeah, and that's why it's kind of important to pay attention to which index they're actually basing their fund off of, because there's a lot of different emerging markets or indices. There's a lot of, the fund name doesn't always correlate exactly with the index that you follow, so that's also something to pay attention to.
Wait, the high yield, this high yield. What's that? Sounds good to me.
Yeah,
For the growth, I'm gonna do that growth, like the growth deal with that.
yeah, so a lot of the other things is you might see the growth fund, you might think, oh, that's following whatever growth is. But a lot of times that'll be an active managed fund. So Vanguard will have both growth index fund and just managed growth fund. It's very important to know what the difference is. There's a couple extra indices that we look at, not all of them that we use. Those top three are what you'll see in your investment most of the time. And then the sector indices, but these are just some other ones you might have heard about. The NYSE, so New York Stock Exchange Composite, we have measurement of the performance of all the common stocks listed on the New York Stock Exchange. So this includes American Depository Receipts, also abbreviated as EDRs, real estate investment trusts, REITs, and tracking stocks. So this is what we like to use a lot of times in our office for our overall stock market performance, because it is a good gauge of a whole lot of diversified different sectors and different investments that we have, all brought into one track index to see kind of how are we doing to the overall general market. There's another index that people like to use for a total stock market. That's called Wilshire 5000. So that includes about 5,000 stocks with this changes. And that's another way that you can measure your portfolio performance based on the total market.
The interesting thing about these indexes, Wilshire 5000 only has like 1,800 stocks. Because a lot of them, they got bought back or something. Is that what they did? They bought their own stocks and they went private and stuff. Yeah.
What did you say, the index that you like to look at?
We like to look at the New York Stock Exchange Composite. That's one of our favorites. So it's so diversified, it has a lot of different stocks. Remember what the number is?
And how many are on it? I'm guessing about 2,300, but it has real estate investment trust stocks as well as small companies. So it's more of a broad market, whereas the S&P is only, I think it's about a fourth or a third in technology. When it's up, you love it. When it's down, it dumps.
Yeah, those big indices are very biased towards the top companies just because of how big they get. And with a lot of those other indices, they bias towards what companies are biggest in the market. You can get ETFs and mutual funds that are equally weighted versions. So if I'm getting an S&P 500, a normal S&P 500 fund will have most value, but an equally weighted S&P 500 fund will have the same amount of capital at the bottom stock. So there's some little differences.
Which one do you recommend right now, given the market where it is?
And we don't recommend that. Well, equities are, it's hard to recommend to dive into equities. We obviously love some equities in the portfolio, but I would be very popular.
If you do get nervous, you can go to the equally weighted because most of the average stocks in the S&P aren't up that much. When you look at a balanced portfolio, well, it's kind of not up very much or in the stocks because the tech stocks took off, NVIDIA and all those. But they did a tank overnight. We saw it last year. A year and a half ago, they were down quite a bit. And if you feel like you're missing out on NVIDIA, won't it already right now?
Another one that we can look at is the FTSE 100, that's Financial Times Stock Exchange Group. So this is just one of those foreign indices. This is a British organization that specializes in providing index options for the world. And the FTSE 100 is a pretty good gauge of the British market. different, European markets.
I always thought that was foreign trades. Thanks for pointing that out. What's in today?
Like, yeah, there's a lot of different things that you can look at. This was just six of 100 and thousands of different indices and areas. So you don't see something up here that sounds like what you want to be investing. Don't worry, there's plenty out there to choose from. So when we talk about fund strategies, there's a couple of different things that we can do, but we'll just break them down into a couple simple different categories. The main two are passively managed and actively managed. We have index funds shown separately, but those are really just the passively managed fund. Passively managed funds are usually things that have very low internal turnover. We're not buying and selling a whole bunch of different stocks, and maintaining our initial allocation with a little bit of balance. Index funds are a good example of that. They follow the index, and usually the only time that any changes are made are when the index itself changes. So we're not looking for them to do extra trades for us, not expecting to beat any other index because we're just following. So a couple of different examples of index funds would be things like SPY. You might be familiar with that. That's an S&P 500 ETF. QQQ is a NASDAQ 100 ETF. And FSKAX is a total market control fund. I don't remember which index that's based off of, but it's one of our cheapest total market index funds. And it's one of my favorites just because of how low it is. You're paying, I think it's maybe 1.5 basis points for the management fee, but it's a great thing that it's very low. Versus when you look at things like SPY and QQQ, they're either a little bit higher. So something I've been doing is actually looking at finding places for them. Actively managed funds are the opposite of passively managed. That's where the fund managers are actually trying to pick stocks or find market trends or analyze the current conditions and look for opportunities that they can capitalize. But all of the things that they do have to align with the fund objective. Whatever it is they say they're going to do, that's what they have to do. They can change their mind later, so pay attention to your funds. If they ever end up changing their mind, you want to pay attention to that so you don't end up going in the wrong direction. But actively managed funds, things like T. Rowe Price capital appreciation, or a lot of other bond funds that you might have heard of, are where fund managers are actively keeping their eye on the investments at all times, whether they're trying to get the most growth possible, or have the most downside protection possible, or anything like that. This could also include something like option selling funds, something where you might have S&P 500 index funds where they're selling options, whether it's on the upside or downside, to try and generate a little bit of extra return and or create downside protection. So exchange traded funds. Let's talk about these particularly. Let's talk about some of the reasons why we like them, some of their characteristics, and how we might use them. The ETF shares represent a piece of a pool of investments. You can think of it like it's like a stock where they issue a bunch of shares and they sell them on the open market. But the company that you're buying the stock of is a company that buys stocks of a whole bunch of other different companies. So you can buy your ETF shares directly through your brokerage firm, like Fidelity, TD Ameritrade, Schwab, investment consumer banks, all sorts of different things. These accessible regardless of where you are. And when you're buying and selling ETF shares, just like a normal stock, you're buying and selling other investors or market makers, or even from the future, whatever. Why might you want to use an ETF? So an ETF, like a stock, trades throughout the day. Like you can with the stock, you can watch the price of the ETF fluctuate up and down throughout the day. And whenever you place your order, as soon as there's an available counterpart to that order, it fills, and it can be inert. And that can be something where if you are a little bit more active of a trader, or you just like looking for that better entry or exit, you might like ETF because you might not only like trading based on what the daily chart has to offer, you might be able to show some fluctuation. When you compare them to a mutual fund in tax sense, they are considered tax advantage in comparison. Now, the reason for this is because in general, for almost every ETF that I've ever seen, they don't distribute their capital gains. There's some fancy things that they can do internally by changing their funds with other market makers or fund companies so that there's not actually a sale, so they're not generating capital gains to distribute out to you. It is possible that they can distribute capital gains, so there's nothing stopping it. But for the most part, it doesn't happen. And the benefits of this, it sounds kind of specific, complicated. What's the actual benefits? Well, when you're holding a fund in something like an individual account or a trust account or anything like that, you're liable for all the taxes that are generated in that account as they're generated, like we talked about before. Those tax consequences are due this year. So if you are holding a growth fund and they do a major sell-off of all the assets they're holding and they kick those capital gains out to you, you're liable for the taxes. You might not have been ready for that. I've seen a lot of situations where you have investors that just simply don't really know that that's what's coming. So you'll have a lot of mutual funds all stacked up, and at the end of the year, they kick out a whole bunch of capital gains, and you look at your tax bill and you go, why do I owe another $10,000 in taxes? I didn't make any extra money this year. I didn't get a bonus. I didn't get a raise. But lo and behold, your capital gains shot through the roof because all of those funds made adjustments to their investments inside.
And it was reinvested, you didn't get the money.
Right, you didn't get the money. It got reinvested back into their portfolio. So why you might want to use an ETF is in one of those non-qualified accounts where you don't want to have any tax burdens. Where if you are not having a whole bunch of free cash flow in your day-to-day life, and you don't want to have to save aside to pay for this, you might go into ETFs instead, where it's much less likely you're going to get a distribution of capital gains for the other taxes. Now, mutual funds. Talk about the difference here. Mutual funds are bought directly from a fund company. Even if you're buying them in the brokerage account, you are buying funds directly from that mutual fund. You're not buying it from a different investor. You're not buying it from a market maker. You're buying it straight from the fund company. And you're buying it at what's called net asset value. Now, because you're buying it at net asset value, you only receive your share or complete the transaction at the end of the day. There's no intraday trading. You can't buy at 9 in the morning and have your order filled by 9:15. If you buy on stock market open, you gotta wait till stock market close, but that's the show right now. Now they do settle a little bit faster. Stocks and ETFs settle in 2 days, mutual funds in 1. But you also sell and redeem these shares at the fund company. So when you are trying to get your money back, you're not just going over to Joe over here and saying, you want my 5 shares of FSKAX or whatever it is. He gives you the money and you give him the shares. You have to place the sell and give your shares back to the fund company. They will give you your money back, basically like the team. Now, the thing about doing that with mutual funds is that means you can invest in an exact dollar. So if you are looking to put $5,000 into the mutual fund, you can put just $5,000 into the mutual fund. With an ETF, you have to buy $5,000 worth of shares. Might end up spending $900, might end up spending $100. It will be a little bit off unless you have shares that directly equate how much money you put in. So if you really like those round numbers, mutual funds might be.
So ETFs did not buy fractional shares like stock.
Well, it depends where you're buying from, because that's something that a broker offers. So like our broker dealer doesn't do fractional shares, we just do full shares. So it kind of depends, like that's something special that's been out recently where these smaller brokers, usually stuff like Robinhood and stuff like that, will offer fractional share investment. I'm not sure what the catch is to all of that, if we're taking that too far, but it's not something that you're generally going to be offered in the most part. Like we mentioned, capital gains are distributed from internal fund activity. So if there's turnover inside and there's capital gains to be distributed, it's like you own a faster entity like an LLC or a partnership. When the gains get generated, they push out to you on own tax. Reason why we might want to do this is if we have something like a tax deferred account. If we have a tax deferred account where we're not liable for taxes today, it doesn't matter. It's not affecting our tax liability this year or next year. It's only became a problem when we decided to do it out. So if we're looking at something like an IRA, a mutual fund might be totally. We might be looking for very specific exposure to a sector strategy that is not offered in ETF. That's going to be hard for us to find these days, but it's possible. Or one of the problems, not usually going to be a problem for you, but is going to be a problem for us as professionals, is similar ETFs. Say we have a very specific strategy, or maybe one of the big one specs or big one mutual. The ETFs might have low volume or high spread. So what does this mean? Low volume basically means there's not very much money going back and forth in the market every day. So if we only have a couple grand of dollars going back and forth in this ETF, but I'm stepping in as a professional, I have 3 different clients who want to buy $50,000 each. That's not going to really work for me because there's no counterparty to that trade. So if I put that order in, some of it could get filled, some of it could just be pending or get filled at ridiculously horrible prices for my clients. That's not something I can do. And that's where spread starts. When you have very few people willing to make a transaction, you have not very many people concentrated around that current price. You might have certain people who are holding shares from 10 years ago and they go, I only want to sell $100. This price it is. You might have people who they just don't really see the value. And like now they only want to buy at 25. You want to you have your share and you want to sell at $50. But if there's not enough people to actually put it out, and you have like a market order in place, it's just going to connect you with the next person with the stock. And if you don't have enough people to fill your order within a reasonable amount of that dollar price, then end up triggering that $25 order and sell your shares at loss. So it's not really usually something you're going to run into with personal accounts where you're not having super high amounts of dollars or tons of shares in trade. But if you're getting for really, really, really specific strategies or very not well-known fund companies, it's something to take into account to make sure that there are enough counterparties for your order.
What's a reasonable spread for an ETF premium?
And that it kind of depends on like what they're going to a sector. So if I'm looking at an index fund, I want it to be maybe a few pennies or tens of pennies. I don't want to be losing very much at all because I would expect there to be a lot more sector. But again, if I'm looking at possibly a Bitcoin or something really specific nobody's ever heard of, for that instance, I like it. 3%, 5% spread might be reasonable, but that's what they're going to be taking on just to get into that sector. So it kind of really depends on what you're trying to get into, what you're willing, what trade-off you're willing to make to keep that investment in the first place. But when we're talking about really, really popular stuff, we want to see minimal, almost nothing, pretty much no spread.
On the spreads, Nash will let me buy something if I promise it's going to be in the portfolio a long time, if there's a bigger spread. He doesn't want me coming back saying, okay, we want to sell it 6 months later because you're getting a bigger spread or losing some money if you go to sell it right away. It's kind of like you buy and sell a house every other week. The commissions will eat you up. Spreads could be looked at like a commission, but you could buy and sell these big indexes that have a very small difference between what you get and what they buy it for. So if I'm going to buy and hold something, spread isn't as much of a concern, and it could specialize. But you don't want to be frequently trading price spread. Yeah, exactly.
Do you do like a stop loss on the ETF?
Yes. Yeah, you can do stop loss. You can also do link orders. So if you want to make sure that you only fulfill an order at a certain price, it just will be a little worrisome if you go to place market order with super thinly traded stock ETFs. You might be a little surprised at the price of that. So we'll compare this to mutual funds versus ETFs. A lot of these things are pretty simple. On a mutual fund, you're trading what's called the primary market, which is just between you and the issuer. So it's just that first level between the person who created the investment versus who has to purchase it. ETFs are trading what's called the secondary market. That's basically your stock exchange, while investments are going between different people. So I could sell my investments in, me, set it around. It doesn't have to interact with the fund company at all. That allows for a lot more, a lot of shared things around. Capital gains distributions come out on mutual funds. So if you hold your mutual funds in a non-qualified account, It's possible that it's the tax liability in the year. Versus the ETFs, for the most part, again, it's possible, but usually they don't pay out any capital. Usually they're gonna be holding or doing some interesting swaps. If you want to talk about those swaps, if you want ETFs, to not be capital securities.
Oh, I don't know anything about swaps, but inside, if they're gonna, well, I guess it's a swap. If they have a big stock that they need to get rid of in the exchange or in the ETF exchange, they find somebody else that will trade them a different stock or the same stock with a different cost basis. So it's like if you're a real estate trader and you can trade, and as long as you don't pay cash, you don't pay any taxes on it. You trade for properties, this property for that one. The ETF can trade this stock for that stock and avoid the taxes, but a mutual fund usually can't do that. As efficient.
Yeah, so again, something that they can use, hopefully, use capital.
Yeah, they're trying to make it illegal because it's too good of a deal. The market maker and the authorized participant will trade the stocks. And a lot of the government people say that's not fair because they're able to avoid the capital gains on this stuff. But if they do for a while, you're still going to pay the tax once you sell the shares. But what happens internally stays internally versus it.
So again, with mutual funds, you don't have any intraday trading, so all trades will settle at the end of the day, no matter what. You're not going to be able to place a trade at 9 in the morning, have it fill by 10, and be able to sell by 1. Work. Versus the ETFs, you can do that, trade just like a stock. Anything you can do with a stock, you can do with an ETF. Yeah. Slide options contracts on, sell them short if you want to, all different types of stuff. All that you can say trade with ETFs. Mutual funds, you can put in exact dollar amount. So I actually like doing this. With my 401k, I have 2 funds that I invest in. They're both super aggressive growth funds. But I like the idea of doing round dollar investments. So every time they do distribute capital gains, invest them for me. I can know very easily which portion of that is the capital gains versus how much I put in. So I get in around $5,000 and then they pay out $250 in capital gains. I know just by looking at it in my cost basis, that $250, that's not money I put in, that's capital gains. That's just something. Versus with ETFs, stocks and all sorts of things. You have to buy all the shares. So you might have to buy 22 shares or 23 shares, and that might bring you to $4,975. It doesn't quite get you to that around $5,000. With mutual funds, you have absolutely no concern of volume because your transactions directly with that mutual fund company. So you're not concerned about how many other people in the market are willing to pay for your shares because it doesn't matter to you. The only thing that matters to you is that the mutual fund company still exists and you can keep shares. Versus with ETFs, you have that. So have high spread or low volume, you can have a loss on your position, even if it's trading against you. Yes.
Question on that. If you have mutual funds, the American funds, and you're looking to move into some of their ETFs that they're throwing on the table, and they're only putting like 50 or 60 million each one. Do you have the same concerns of their ETFs as opposed to someone else?
So for actually moving from mutual funds to ETF, I'm not sure.
Well, first of all, if Americans goes to the trouble of transitioning from a mutual fund to an ETF, they give you that ability. It's legally possible if they have an arrangement with the SEC.
Some companies are doing it.
Some are doing it because they don't want to lose the investor, right? They have to say, okay, well, convert this to an ETF at a lower fee, but they don't like to give up their fees. But some of them are in the process of doing that. DST is doing, or what's the other one? DFA, yeah, they're doing. So, but once you get there, what was the question?
Should I be concerned about the risk you're taking?
Oh, yeah. Once you get to an ETF, you'll always have a spread if you go to sell some shares and want to get out of them.
Even with a major company.
Yeah. I mean, if it's a big company, like Nash said, the company size doesn't make a difference. It's the index, what they're trading on. If there's a small spread on an index, let's say the S&P 500, then the spread will be almost.
Well, it doesn't matter if I'm actually index doesn't matter. We don't care about the volume of the index, we care about the volume of the actual. Because I could theoretically have an S&P 500 fund that nobody wants to.
Okay, yeah, you're right.
Yeah. So basically, the answer is yes.
Yeah.
Once you get there, it does.
Yeah, be with a big company, American Fund, which is Capital Group or Vanguard or Schwab, something like that, that would be true. Because that brings us back to the point where some index fund or small ETFs actually don't get enough money, even though it could be a small Dow Jones index, and they got to sell all the shares and give you your cash. You guys are right.
Yeah, so it really what matters is that particular ETF. Is there somebody willing to buy and sell that? Are there plenty of them? Even if you are with American funds and give you an ETF, maybe nobody knows about that American funds ETF. It might take a while for that volume to.
I got a buying alert notice warning from Nash because I wanted to divert from Vanguard Utilities Fund to Fidelity's Utility Fund, so I don't have all my money with Vanguard. But it was a smaller Vanguard Fidelity Utilities Index Fund, and he's warning me that look, if they don't take off, you're going to have bigger spreads here. We don't want to also have too much money with Fidelity's new little utility index fund, because if I want to move all my clients' money, it might affect the funds. That's what he said.
Yeah, so basically the idea there is, like I mentioned before, this is more of a concern for us than it is for you. We are trading lower volume investments, especially if we're looking at impulsive clients. We can actually end up affecting the market in some extent. So if the market is small enough, if we are big enough players, we can actually trade so much that we push the price up or down. And when that ends up happening, that ends up being kind of a red flag in regulators' eyes, especially our companies. Because it might end up looking like market manipulation, even if we think that.
I convinced them in their long-term trades and Fidelity's fund will grow, but I have to go to him to get permission.
Yes.
So I'm looking for my accounts. I have Schwab and stuff. Global investor, that's managing it.
Yep.
And I believe a lot of the funds that it invests in are ETFs, so it's buying and selling those. Do I need to be worried about the spread there?
I think that's something that they're going to be managing for you, because a lot of times, especially with robo advisors, it's going to be understood that a lot of people are going to be in very similar investments. So I don't think that that's something they're going to be able to look. I think that would be something you really do take into account.
Yeah, technically you would eat that cost if they were irresponsible and trading too much on local funds. Yeah, she was.
I'll put more about the entities who are, because they have competition on ETFs. So I have to do some doing mutual funds, and I read that they started ETFs, but I haven't heard anything about it. So they're just separate. Are they handling separate unless I choose to sell one and buy another, or do you have any thoughts on that?
What I heard is some of the funds that you have to contact them and say, I'd like to convert to your ETF. Some of them will do that, like with the Bitcoin stuff, the futures to the Bitcoin fund or something.
Right.
So, yeah, I would look up DFA and just see what they're doing, but they might automatically convert you. But DFA is a index group that came up with their own indexes. They did a fabulous job, way ahead of the market. But now their mutual fund index funds that have expense ratios are like 2 or 3 times what you can get in the market. So they're having to convert to ETFs, but they're still not the lowest.
But if they did that, that would be really good for the capital.
Absolutely. That would be the way to go. Yes, right. You're exactly. Yeah. There was another question. Yes.
Yeah, if I have, let's assume that I'm gonna pull some money out, I need some cash available. And if I have money in retirement, but it's a capital gain, say I sell stock. And so we know that the capital gains tax is at 15%, but this is in a tax deferred account, and my current tax is, let's say, the federal are 25. What tax would I receive on the capital gains from that stock liquidation?
In a qualified account, capital gains are null. They don't exist. Because you defer those taxes when you.
But I'm pulling the money out.
So if you pull the money out, you're going to pay ordinary income tax on all of this. Regardless, it's not going to be any different because there is no differentiation between what is a capital gain versus what is. It's just money that you didn't pay tax on initially And now that comes out of your career and you pay all those taxes today. And that's why generally we hope that with qualified accounts, you're avoiding a higher tax so that later you pay a lower tax.
And so the same question would be
That may
in,
not be true.
the same question is in a trust account.
Sure.
So if I have a stock or a money market, the money market's paying 5, the stock is Apple. And so I need to, which one would I liquidate? This affect capital gains. To me, it seems like I would want to liquidate the one where the tax is going to be 15%.
Right, so again, with a trust account, those taxes are gonna be paid in the year they're approved. So if you're having something like a money market fund, generally you're gonna be holding it, and that's gonna pay out interest to you, and you'll be paying interest, you'll be paying taxes on that interest along the way.
Right.
So when you get to the end of the period, you have all this money market funds, you're probably gonna pay almost nothing to take those out, because there isn't gonna be big capital gains, because they don't actually grow, it's just interest bearing. And you will have already paid the taxes on the interest along the way. Versus with a capital gain stock that's held in there, because you haven't sold it, you haven't paid taxes on it yet. So then when the sale happens, that's when the liability.
No, I understand, but let's say we're talking about this week, right?
Sure.
That I'm trying to decide if I want to liquidate, cash or the capital gains.
Right.
And so the cash would be at a taxable rate of 15%, right? Versus the stock would be at 15, no?
No, because the money was taxable currently, already it has been taxable this whole time. And because cash does not move in value, there's nothing to be taxed on. So there's no capital gains to paying.
You paid the tax last year, your dividends were paid last year.
Yeah, exactly. I would use the cash for tax reasons unless you need to have cash available. And then in the future, you say, I don't want to pay taxes. There are money market funds that are municipal based that are paid 2% tax free. Yeah, but unless you need the cash for emergency, I'd use that instead of the stock. But then the same thing could be opposite. And all of a sudden you don't sell the stock and next week it crashes. You say, but Bill, I should have sold the stock. So there's two sides.
Yeah, but then you do a stop loss of it.
There you go.
Exactly.
Oh, okay, yeah.
So just like as a basic question that probably could have been asked earlier, why would you even use funds over stocks anyway? So a lot of people they like to pick their own stocks and have all of this, have this diversified portfolio themselves. And why would I want to pay a fund manager fee? Why would I want to deal with all this other stuff? Simply, just want to defer the workload. If you don't want to do the work, there's a lot of really, really knowledgeable experts out there to deal with these one. If you even make it so simple, not that we recommend this, you can simplify your portfolio so much that you can buy funds that create entire portfolio allocations for you. Well, obviously, you can buy and sell just for that fund, but you keep it very simple with your allocation. Like I mentioned, again, you're paying for experience. You're paying for the time they've been around. You're paying for the tenure of the managers that have been maybe doing it for decades and decades. There's a lot of funds out there. Some of the best performing ones are fund managers who have been here for 20, 30, 40 years, who have seen the different characteristics of markets and they know how to do it. A lot of newer people don't necessarily know how to set themselves up for when these big events are going to occur. You also get the benefit of diversification. When you invest in individual stocks, you put a lot of your eggs in one basket. And we'll talk about why that's bad later, but just for right now, trust me, it's not the best thing. But when you go into funds, generally you'll have funds that have hundreds, if not thousands of stocks within them. And you get the benefit of that diversification without having to go and buy hundreds or thousands of stocks for your own portfolio. So you can consolidate those positions into a few different funds versus having thousands of different stocks from all over the New York Stock Exchange. So really, buying funds is paying for that convenience of all of it being done for you. And you can then further diversify by diversifying between funds that diversify between stocks. So really, it's just deferring that workload over to professionals who have been doing this for a very long time. Now, if you have the experience and all the expertise, be my guest, pick your stocks, and come back to me and tell me how the returns are. But other than that, if you have any questions, comments, anything you're thinking about, what can you do?
On that last topic, we're used to seeing mutual funds that had excessive management fees and were irresponsible and excessive trading. And I want to show up on Money Magazine and they gamble and they lose their money. But then we went to index funds where they didn't do any of that. The cost was really, really low, and we just get part of the overall market. Avoiding all the old fund stuff, the newer index funds, fine, but are you finding any really good managed funds that are responsible at a fair fee? Because I say overall, all managed funds do less than the index. They can't beat the index, but there are a handful of responsibly managed funds. And there's ETFs that are used to be all index funds. Now a lot of them are becoming managed because everybody wants a part of the management stuff. Are you seeing some managed funds that are worth it?
There are a couple, there's really two funds that I can think of that I think are worthwhile. And they're actually what I invest in for the majority of my 401k. One has been Franklin's Diet Tech Fund. They've just been a really good performer in the tech space. I haven't gone back and compared to every index that I can find. So there's still some due diligence to be done, but I've seen it hasn't been standard deviation high, but it's nothing that's really very too much. Then there's also the T. Rowe Price all cap opportunities fund that has actually tended to be risk adjusted better than its index over a very long period of time. It doesn't necessarily mean they're always going to be performing best, but it means that for the level of risk that fund itself takes on, they tend to perform better. There are some funds that are like that, but I wouldn't consider the whole rail of it.
Where is the closed-end funds fit?
I mean, it's not something that they would have huge cases, but something like a unit investment trust would be something. Usually, the idea for what those are going to be is we're going to buy a big allocation of bonds and then never touch it again, wait till they mature. Something like ladder or bullet strategy, something where you have a lot of different bonds all going for the same maturity date. But I don't have a bond.
And as we talked about before, they're leveraged a lot of times. They'll take on debt. And so in some of these 2 times, 3 times, 4 times, meaning I want the S&P 500, but I want to make more than the S&P 500. Well, you're not going to. You're going to make what it makes. No, I want to make more. Okay, give us 50,000 and we'll buy $100,000 of the S&P and we'll leverage it. And when it goes up, you'll make twice the return or 3 or 4 times the return. Closed in, they don't bring in new shares, right? Is that right?
All right.
They start with so many shares, you have to buy those shares from somebody else, but the fund is not responsible for taking in, buying the shares back if you want to cash out. They leverage quite a bit, there's quite a bit more risk, and the assets in the fund could be more or less than the actual shares that they list, right? So if the assets are worth this amount, and but the shares selling at a big discount because they're not bringing in new investors, right? Yeah, because most mutual funds and ETFs have market makers that if the prices start falling, if the share price falls below the assets in the fund, then they'll buy or sell to try to bring it back in line. So you know when you go to buy or sell that the shares, the assets in the fund are worth the same as the shares. You're getting a fair deal. Closed-end fund, the actual assets could drop below the share price or above the share price, and it could be very, very dangerous. But we only recommend the smartest people around should deal with closed-end funds because they can be very dangerous.
Yeah. Now, a word on leverage funds and why they sound like a great idea, but definitely not in the long term. The way that a lot of leverage funds, 2 to 3 to 4x index funds, the way that they work, they don't just magnify returns over the long term. They actually release economy will reset every single day, and they will attempt to magnify the day's return, right? Not the weeks, not the months, not the years, not the decades. They'll magnify the days. So you'll have this scenario where you have a few bad days. You'll have a minus 3% day, but you were in a 3x, so you got minus 9. Then it resets. So instead of going back down from that level on the same compounded basis, it will reset, and then whatever the performance is for the next day, it will try to leverage that. And then it will reset again, leverage that. What we find, all of these long term, is that the downward snowball is a lot faster than the upward one a lot of times. You can have a bad performing week or month, and it takes you down to 80%. And it can get really, really, really bad. It keeps resetting every single day and magnifies the next day's return rather than the long-term compounding. And mathematically, it's hard to understand that with a simple explanation, but it does not go well. So oftentimes, these funds are to be used for intraday trading, not for long-term.
So in a closed-ended fund, if you want to get out of it and no one wants to buy your shares,
Pretty much, yeah. And if they want to close and sell the assets, they send you what's left. But if you, like you said, you got to buy it at the right time during the day. Because I would have, I'm watching the charts, look at this, went from here down to there. I'm going, what the heck happened? But that's what, right? It's really dangerous. And if you're a speculator or a daily trader, maybe you like that.
So, any other questions? Yes.
I guess the first tech fund, what is that fund and what are the caveats you can see?
Oh, in terms of the managed funds?
Yeah,
Yeah, so it was Franklin's Dyna Tech. So it was DYNA teams. I just haven't done a lot of comparison between the C's and other tech, but it's just something that I've done for a long time. I've seen a lot of good results. So it's just,
that's to bring up the technology.
yeah, I'm not sure exactly. That's the one that I.
Yeah, you'll find some with different companies, but they have a history of good management. And that pyramid thing that Nash talked about, most of it's total market index funds and S&Ps, low cost. But when you get up to the top, you get into dangerous investments. What kind of investments would be dangerous that we should have?
Probably, I guess, it depends.
Well, let's say junk bonds. If you don't want to gamble on an index, you just want to have somebody that can get you in and out of junk bonds, because there isn't a bond in the market like the stock market. You've got to be tied into traders that can get you in and out if you want to sell the bonds, or an ETF that has a good connection. So if we're going to pay for management, in our opinion, should be the specialty area that we just don't want to buy one. Everything technology, now Bitcoin. I'd rather have a good manager, pay a high fee until Bitcoin becomes more, averaged out. Then I'll go to a low cost index fund. But if it's not a dangerous area, sure, an index fund is a lot less exciting, less stress.
Well, with that, we've reached the end of our time. If you have any other extra questions, Chad will be around for the next 30 minutes or so. But other than that, hope you have a good one. Hope you win.